Good afternoon, Ryan. How you doing today, sir?
Good. What's going on, Mike?
Just another day here, another Friday, Facebook Live, talking about some new things that we're seeing in the marketplace, which is really interesting. Also, not excited that the year's halfway over, but there's nothing we can do about that. So here we are, halfway through 2024.
Yep. You got the weather starting to change. We got summer ahead of us. School's getting close to an end, so there's some exciting things, right? We're all
Yep,
looking forward to vacations and all of the stuff the second half kind of brings.
for sure. And yeah, yes, looking forward to those for sure. But the vacation thing, I guess that ties into today's topic pretty good. So we were talking offline and saying about how we're seeing some new trends in credit scores when we have people coming in and applying for loans and doing their various things. And um, I guess I was kind of surprised, but then also not really. So let's dive into that and see what the negative ramifications could be if we continue this course.
Yeah. So, as it relates to like credit scores, there's a little bit of a trend that I'm seeing on my side. I also had a conversation with somebody who's in the auto industry that does auto lending, and they were seeing kind of the same thing.
Okay.
And what it is it's a lot of times the credit score incredibly low, damaged by a variety of things. And you take a look at it, and if they're a homeowner and they have a mortgage, the mortgage is current, but everything else is delinquent or everything else is maxed out. So we're kind of seeing two different paths, right? We're seeing folks that are really, really stacked on the credit card side of things. Like those are all completely maxed out. And so when you start to max out your credit cards,
Mm-hmm.
you're going to roll back on your credit score a little bit. You're going to lose some points because it's the credit bureau's way of slowing down your acquisition of new credit. So they're going to drop your score tab because you're utilizing all of the available credit.
Yeah.
It's kind of a sign that maybe something's not right. And so they're going to lower down that credit score. So that's one thing. And then the other is that I think people are just generally getting a little bit too extended. And
Yeah.
what's alarming is when it's a homeowner and we see, an application, a lot of times it comes in on our side as a refinance. And they come in on this refinance and it's too late because they've already done some significant damage to the credit.
Yeah.
They've gone late on things. They're really, really high on the overall ratio. So the credit score is damaged.
Yeah.
And what they were trying to do is preserve this amazing interest rate, which is, I get it. We don't want to get rid of the low borrowing cost on our most expensive debt.
For sure.
So, but the other problem is that we kind of ignore, we turn a blind eye to all of the other consumer debt that starts to stack up.
Mm-hmm.
And what we really have to do is we have to look at the entire amount of debt that we have. So if we have a 3% mortgage
Mm-hmm.
and you got, let's call it like $400,000 worth of equity, which is not uncommon, right? The
Yeah.
values have climbed up. So if you've owned a home for a long time, you got a pretty good amount of equity there.
Yeah.
And at the same time, you probably still have, this alarming amount of, consumer debt, right? Credit cards, personal loans, you name it, auto loans, et cetera. We're seeing, some pretty heavy debt that comes across there.
Yeah.
So what you actually should do as a best practice is do a blended average of how much is all the debt that we're paying. So if I'm paying 3% on my mortgage, but I have, 26% interest on, the majority of my credit cards,
Yeah.
that blended average may not be 3 or 4%. It may be like 6, 7, 8, 9% interest. And so then you have to kind of take a look at, can you shore that up somewhere? Can we save some overall costs, right? I am going to sacrifice potentially
Mm-hmm.
this lower rate, but I'm going to wipe out all the other stuff that I'm kind of leaking off over here on the side.
Yeah.
And you can do that with the refinance. You can also do it when you're doing a move up, which I think is incredibly important if you're going to sell your house,
Mm-hmm.
to take a bigger picture look at what you have outstanding and then move up for a less amount of total outgoing expense into the nicer home that you really need. You don't have the credit card debt, you kind of reset everything. You
Mm-hmm.
did it in a healthy way if you got to us early enough versus coming in, when things are really, really far behind. So those are the kind of the trends that we're seeing on this side. Again, mortgages are typically paid current because people don't want to lose their house and they don't want to lose that great rate. But a
Yeah.
lot of the other debts we're starting to see either stacked up too high or just they're starting to fall behind a little bit on payments.
Yeah. And that's causing, so like you said, like it's causing credit scores to come down because their credit card balances are too high. They're over like the third or whatever it is that, they kind of like to see. and now their minimum monthly payments are high, so their debt to income ratios paired with the credit score potentially are causing them to not be able to qualify for the mortgage. So that sounds like when people come to us too late, right? Like, okay,
Yeah.
you know, they just kind of ignore the problem for however long and realize like, oh no, I got myself in a bad spot and I don't know how to get out of this now. Maybe now I can be willing to sacrifice the very low interest rate on my home and see if we can shore this all up. But they waited too long. Is that what I'm hearing?
Yeah, absolutely. Look, it's uncomfortable to kind of run through all of the numbers and kind of face all that debt and all the interest you're paying. Nobody wants to see that. Nobody actually wants to do it. So a lot of people just kind of ignore it. They make the monthly payments, they kind of hide behind it until it starts to stack and like there's no more money to pay that stuff. So
Yeah.
what you have to do is you have to kind of take some time, set aside a little time, take a look and see, where can I shore up some of my expenses and is there a way out of this credit card debt? I've seen some of them as low. I've seen people that are concerned about credit card debt when they have like 4 or 5 grand, and those are pretty easy ones to shore up. Not a
Yeah.
big deal, really. But for
Yeah.
them, if they're not used to carrying any kind of debt, they are freaked out. And I've seen others that are like, $120,000 in credit card debt and kind of nonchalant about it. And you're like, wait a minute, why are you so nonchalant? That's a lot of cash. And it's just an interesting perspective. And I think having a little bit of an awareness as to, what's your exit strategy to get away from that? Because nobody wants to pay that stuff forever.
Yeah.
You need to know what that is. And if you don't have it in just your normal earnings potential, then you probably should take a look at if you're happy with your house, using some of your home's equity. And if you're not happy with your house, is there a move up strategy that would unlock maybe the better house that you're seeking
Mhm.
for a total outgoing payment that's less than what you pay right now between your home and the credit cards, the car, et cetera? And I think that's the miss that a lot of people they're overlooking that part of it right there.
Mhm. Well, they're just not revisiting their budget if they have one. And, and I don't know how many people that aren't business owners actually go through and look at their budget on a regular basis. Then we had this talk at the beginning of COVID. We had a conversation about how our economy was shifting into a subscription based economy. Like, and I right before COVID, I remember, buying a new cell phone or something, and I was sitting in Verizon, and the people were trying to upsell everybody. They're like, oh, well, you don't have to buy your phone. You can get it for $20 a month or whatever it was, right? And then they were selling them on the iPad. And I was like, wow, this is going to be crazy. And then fast forward a couple of years, like I have not been able to pay cash for a phone in full upfront. Like the most I think they let me do is pay 50% upfront. And then in the first month I can pay it off or something, but they don't let you pay cash. I say that because I think that that's kind of how, we saw the red flag in the beginning of COVID, like this is going to be interesting. And I think that people mostly innocently, if not just naively, their monthly expenses have crept up because it's all of these little subscriptions here and there, and it's $20 here, $30 there, right? And a lot of people consider those non-negotiables, like Netflix, right? Like there's no way I'm getting rid of Netflix, even though it's like $30 a month now, when it was 10 before. But I think, before all of that, we were just used to like car payments, house payments, credit card payments were like the normal monthly thing. And now it seems like everything is monthly. And because it all hits automatically and just a little bit here and there across the month, I don't think people pay attention as much. I don't know. But I remember talking about that a few years ago and thought it was scary, but here we are living that dream. So
Yeah, it's a little bit of a creep. You have, like, to your point about Netflix, used to be, let's call it $10. I don't remember where the reference point was. I think it was like $10 or something
I
like
think it was
that.
$9.99, yeah.
And it was 15, then 17, then 19, then 22, right? Just kept going and going and going. But you opted in when it was low. For most people, on a lot of the services, they opt in when it's really, really low, and then it adjusts, 20%, 30%, 40%.
Yeah.
and you're kind of used to using those services, so you really don't want to pull away from that.
Hmm.
And I guess what, this conversation is more so for us kind of reaching out to our clients. Like we really want the best for anybody that we kind of interact with, whether we've helped you in financing or to buy a home, or we've just talked in the past and we haven't actually got to that stage of full service yet.
Yeah.
The reason we're bringing it up now is because we need you to make some of these changes today,
Yeah.
right? As we move into, some summer months where spending and vacations and fun and entertainment starts to stack up,
Yep.
I really want you to be able to do those things guilt-free, but I also want you to have some kind of like brackets maybe around your spending habits and a game plan for what you're going to do if you are carrying some of that debt. How are you going to tackle that and get rid of it?
Yeah.
Here's the other thing. We all anticipate interest rates at some point coming down. And the only way that those come down is if the feds start to see that inflation is coming down.
Hmm. Meaning spending
hear that.
slows down.
What's that?
When spending slows down.
When spending slows down, yeah. So we all go, okay, good. So let's all participate in that. So we all slow down our spending. But
Mhm.
here's kind of the nasty thing behind the scenes. So that the benefactor is the interest rates will improve, which
Mhm.
makes things better for us. Our spending, short up, which also makes things better for us. But the sacrificial lamb and all of that is that businesses are in business to make money. And if they can't make money because you're not spending, they need to cut their number one most expensive item on their balance sheet, which is their employment.
Yep.
So we actually see unemployment kind of stack up a little bit.
Mhm.
Now, mention that because you may be working at a place where you are one of those kind of targeted individuals where they go, our numbers aren't where they need to be. We're going to have to reduce hours or get rid of overtime, or worst case, like no employment at all for you.
Yeah.
And so, as amazing as it would be to see these interest rates come down and see just the general spending kind of slow up a little bit, so we don't see this huge inflation. We're not seeing the fast food prices at an enormous rate like we're seeing right now. All the food cost starts to come down.
Yeah.
It's going to come at a sacrifice, and there are going to be some bystanders that are kind of left on the wayside without a job
For sure.
as a result of that slowdown in spending. So I don't know where that's going to head. Hopefully, none of our clients really experience or feel that, but the good best practice right now is to get ahead of that and kind of
Mhm.
shore up lifestyle and make sure everything looks okay,
Yeah.
so that when that kind of rainy day comes, if it does in fact land in your neck of the woods or in your home ownership, right, in your household, then you're prepared for it.
Yeah. So, I guess going back to like baby steps, right? Like make sure you've got your emergency fund and then start snowballing your debt. If your credit's good now, great. And if you don't have overwhelming debt, great. Don't bring it on, right? And if you don't have a lot of debt and your credit's fine, start stacking cash, right? In case the rainy day comes for employment. And most people don't think about that, the two-edged sword of, the interest rates coming down. There's a reason for it. There's cause and effect, and you don't want to be on the wrong end of that for sure. So just get back to, saving up your 6 months if possible for a rainy day, and, shore up your debts and get that done. And if you are experiencing financial hardship right now, like let's come up with a plan, whether you're a homeowner or not, let's come up with a plan to prevent your credit from getting damaged. And if you are a homeowner, we don't want your credit getting damaged to the point where refinancing is not even an option anymore, and you're stuck with selling off your assets, be it the house or the car or whatever, to pay off your debts. Like no one wants to get there. Everybody's worked way too hard to get where they're at, that it would be a real shame to just have to give it up.
Yeah, absolutely. I mean, that you got to get ahead of it. So you have to kind of predict or see, is there even anything in my potential near future that could be damaging to the way that my finances are stacked up? And if so, then you just kind of, you start to build that. And if you're in the thick of it, there's nothing wrong with kind of raising your hand and saying, hey, could you take a look at my situation and tell me what you would think?
Yeah.
A lot of times we get those calls too, and we're not telling somebody to refinance. Like we may give them a couple of options, and maybe there's no option. Maybe it's just, hey, I think you're fine. To your point, like debt snowball, let's kind of slow the money that's going out for an investment and reallocate that toward liability payoff. There's other things we can do sometimes that we can see very clearly, but sometimes when you're in the thick of it, you can't really see it as clear on your side. So
For sure.
yeah, just a good best practice for everybody. And again, as we head into that second half of the year, let's just make this a kind of a priority in our households.
Yeah, for sure. All right. Anything else you want to touch on as far as trends go with credit, and anything else we're seeing in the market right now?
No, I think that was really it. I was just, I'm starting to, when you see the cracks in the credit, it becomes a little bit concerning because, I think, let's be real, it's really expensive right now to do anything, to
Everything.
go fill your tank, to go out to eat, to go to the grocery store, to pay your insurance, to pay your house, to pay your rent, you name it, right? Nothing has gone down that I've seen. Everything is very expensive. So I think that will eventually slow a little bit, but also we have to kind of recalibrate maybe our spending habits so that we can get ahead of that.
For sure. Yeah, it's catch it while it's just a crack. Like right now,
Mhm.
and that's a glimpse into the future. And so let's talk about one more thing real quick. So when you do qualify for a loan, generally, how long back in history do you look at on a credit report?
Well, so the credit report, we're looking at it in real time, but your
Real
credit
time.
score, to give you kind of a quick overview on credit
Yep.
score, your credit score is kind of a reflection of your habits over the last 10 years.
Hmm.
Now, it's most impactful for the last couple of years.
Hmm.
So let's say that you had a late payment on a credit card, you just kind of skipped your mind, you forgot about it, whatever, it ended up being late.
Hmm.
If it was late last month, it's going to have a bigger impact on your credit, right? A worse impact on your credit than it would be if it was a late that was like 3 years ago.
Hmm.
And in mortgage lending, the more recent lates, we are tolerable on those in some programs, but we have limitations. So there are some instances where the credit score itself isn't really what the focal point is. It's more so like what's the behavioral pattern that we're seeing right now. And so if we're seeing three credit cards that are 30 days late and one that's 60 and another one that's 90, and that's all in the past year, there's a really good chance there's no loan there because they're like, hey, let's get all that short up first. Like if you can't make a minimum payment of $50 on that credit card,
Yeah.
how are you going to make a mortgage payment?
Right.
Now, that's kind of how the banks and the underwriting system is kind of looking at things. But again, if it's over a couple of years ago and you had just late after late after late, I've seen them where, everything in life was late for a couple of years, but for the last 2 years, been really clean.
Yeah.
Piece of cake. Those loans go through like nobody's business. Even if the credit score still hasn't fully recovered, maybe it's in the low to mid sixes, it's an easy loan.
Yeah.
Because in real time, that applicant looks much stronger. They look like they're in a better place to be able to afford and make those payments on the new mortgage.
For sure. And especially with COVID being, just behind us and all of the employment issues that happened with that. But again, like if it's just a crack right now, don't let it become a problem, especially if it could have an impact on you over the next 2 years if you go to purchase, right? And same thing with like on the refinance option, like we talked about earlier. Like if it's just a crack right now, and the person's having to refinance, they might say, well, I'm already making my mortgage payment, like I'm good on that, like I haven't been late on my mortgage at all, I'm just late over here. Like refinancing should be no problem, the bank should love me, right? Maybe, but part of refinancing is that their monthly payment's going to go up, and that has to be taken into account, like you were just saying on a new loan. Like, okay, if you can't handle these minimum payments over here, why are we going to trust that you're going to handle this one, which is now going to be significantly larger than your current largest, which is your current mortgage? Like, why would we trust that? So if you are noticing a crack, like the time to act is now, right? And try to get ahead of that as best as possible.
Yeah, I think so. And the mortgage doesn't always go up. I mean, sometimes we're pulling cash out to do improvements on the house, it'll go up, but sometimes the mortgage goes up, but the debt goes down, right? In a consolidation scenario, we may
Yeah,
be
not
paying
the
off
monthly payment overall, not
yeah,
the overall picture of all monthly outgo. That
yeah,
doesn't have to
that
go
part's
up.
going to shrink in most
Yeah,
cases.
yes, because you're going to refinance to pull out money here to pay off these. Like you said at the beginning, like these credit cards could all be at 26%. And yes, you might get a 7% on the mortgage, but 7% is better than however many 26%. And if that's the
Right.
same dollar amount that just goes from at 26% to 7%, it's going to be much cheaper overall.
Yeah, exactly.
Okay. All right. Anything else you want to touch on?
No, I think that was it for now. Just wanted to kind of get ahead of that, right? Kind of help
Sure.
some people at least bring some awareness, plant some seeds. So when they're making bills, they go, all right, maybe I should face the demon here.
Yeah, for sure. Okay. Well, if you guys have any questions, if you want to just brainstorm or talk through something, like Ryan said, have a case by case conversation and take a look at where you're at financially and see if there's anything that you need to do. And a lot of the times we won't tell you to refinance or sell unless that's really your only option. But if it's something easy, like just implementing the debt snowball, like that's what we're here for. We're here to help you guys do what's best for you and your families. And I don't care how bad your horror story is, like we see a lot and there's no judgment. Like it's everybody goes through that. So if you guys have questions, reach out to us. We would love to work through that stuff with you. Like we enjoy doing it. It's fun. We're numbers guys. Not everybody is, and so that those are puzzles and problems that we like to solve.
Perfect.
Thank you, sir.
Awesome. Thanks, guys.
All right, have a great day. Talk to you
All
guys
right, you
soon.
too. See ya.